Today's market pullback didn't come from a bad earnings report, a geopolitical shock, or even a major downgrade in the tech sector. It came from something much more subtle, and potentially much more impactful, a shift in tone from the US Treasury. They've made it clear, they are in no rush to cut interest rates. And in a market that's been running on fumes, pricing in optimism, and hoping for a Fed pivot, that message landed like a punch. So let's talk about what really happened, and why this seemingly small policy hint might signal something bigger. Are we seeing the start of a broader correction? Is this the moment the market finally stops hoping for rescue and starts pricing in reality? Over the past few months, the narrative had been that inflation was coming under control. The labor market was stable. Corporate earnings were decent. So naturally, the Fed would step in soon, ease up, offer support, and carry us gently into a soft landing. But now? That narrative is cracking. Treasury officials have subtly shifted their language. The urgency to cut just isn't there. Why? Because inflation is still sticky. It's not running wild, but it's not rolling over either, especially in areas like energy, housing, and services. And because the economy hasn't broken. It's slowed, sure, but not collapsed. Which means the Fed feels no pressure to act. And that changes everything. It means this market, the one that's been floating on the idea of rate cuts, may need to start standing on its own. The response today was swift. Bond yields rose. Tech names pulled back. Speculative growth got hit hard. And defensives, utilities, energy, even healthcare, held up better. That's not a coincidence. That's a rotation. A repositioning. Investors are starting to internalize a hard truth: this might not be a Fed-fueled rally after all. And if the Fed steps back, fundamentals start to matter again. Suddenly, it's not about vibes or momentum. It's about cash flow, debt levels, and margin pressure. In other words, we're shifting into an environment where weak companies get exposed. And that's something we haven't seen for a while. Now, let's take a step back and ask, why would the Fed let this happen? It might seem counterintuitive, wouldn't the Fed want to maintain stability? But think about it from their perspective. We've seen surges in meme stocks, AI-fueled mania, crypto rallies, and risk-on behavior almost everywhere. That's not the backdrop the Fed wants when it's still trying to control inflation. Jerome Powell isn't trying to spark a crash, but he's not going to stop one either, not if the alternative is fueling another asset bubble. The market getting a little cold water might actually be part of the plan. So while many investors are sitting around waiting for a pivot, that pivot might not come. Or it might come later, much later, than the market had priced in. And that raises a serious question: what do you do now? For starters, expect volatility. Without a central bank backstop, every piece of data becomes more meaningful. Every CPI print, every jobs report, every earnings release, they all carry more weight. Next, expect valuation compression. Companies that don't generate strong cash flow or have high debt burdens are going to face pressure. This is where fundamentals start to shine, or fail. And then there's rotation. Capital is already starting to move toward value, energy, staples, defense. Dividend stocks. Assets with real earnings and real balance sheets. Growth names with weak outlooks or unproven business models? They're suddenly riskier. Just look at some of today's biggest decliners: speculative EV names like MULN, MULN, highly leveraged tech firms, and any stock that rallied too far on future potential alone. That's the story of the moment. This isn't 2021 anymore. And for long-term investors, this isn't the time for hopium, it's the time for clarity. So here's the final thought: today's drop might just be the beginning. If the Fed is truly standing back, letting the market breathe, even stumble, then we may be entering a new phase in this cycle. One where everything gets re-rated. One where patience is a strategy, not a risk. The question isn't just when the Fed will cut. It's whether this market can stand without them. Drop your thoughts in the comments. Are you repositioning? Holding firm? Or sensing something bigger is coming? If you found this helpful, subscribe for more grounded market updates. I'll catch you in the next one.